For more on the markets and the economy, let's bring in Jason Trennert, chairman of Strategas, a Baird company. Jason, great to have you with us.
Great to be here.
You're bullish until the bill comes due.
Right.
What does that mean?
That means that we've avoided recession really at all costs by running budget deficits that are 7% of GDP, which is unheard of when you're at full employment. The problem with that is that there's a cost to avoiding a recession at all costs, and that's inflation. Professor Mundell, Nobel laureate, said, policymakers can either control inflation, interest rates, or the currency, but you can't control all three at the same time. And eventually, just the sheer amount of supply that we're issuing in terms of Treasury securities, in my opinion, is going to drive up long-term interest rates. Or if you don't do that, you're going to drive up inflation. Right. So it's hard to have it both ways, and there's a little bit of like an après-moi le déluge approach to what we're doing in terms of the fiscal policy of this country right now.
Right. So you actually think that long-term rates are going to be higher, it sounds like.
Yeah,
I think because of the issuance that we have and the bills that we have to pay.
I would say just based on issuance. Right. As we know, interest expense now is going to be higher than defense spending. Interest expense will be higher next year than Medicare. And so this is extraordinarily unusual. That's never happened before. And to make matters worse, we've funded everything short. 55% of our debt matures in the next 3 years. The weighted average cost of our debt is well below any part of the yield curve right now. So interest expense, again, unless the Fed decides to buy treasuries again, is going to be meaningfully higher next year than it is now.
It's starting to come around to the way you're thinking. Just in recent months, that it just doesn't feel to me like any of this is organic. It feels like it's all government, sort of the liquidity, the amount of money we spent on all these, chips, inflation reduction, all this stuff that's sloshing around. But the way the market goes up every day, there's all this liquidity, but it doesn't, unless AI is real, it doesn't seem like it's based on any productivity.
Yeah, and Joe, the way out of this is productivity, right? So, I would say when you have a debt situation like this, you either inflate your way out of it, you take some sort of hit, austerity-wise, you raise taxes or cut spending.
None of that.
That's not going to happen. Or you grow your way out of it.
That's not going to happen.
The only thing is, Joe, that what I worry about is I don't doubt AI is a productivity enhancement or Monjaro or whatever it is,
well,
right? That could do it. But the problem is those technologies will probably take longer than the bill. The bill will arrive sooner than the productivity gains, in my opinion, that you'll see from AI and all the rest of it. And I have to say, I'm not bearish on the stock market because.
But it's not for a good reason.
It's not for a good reason. You're fighting everyone. You're fighting fiscal policy now, and pretty soon you're going to be fighting monetary policy.
And then the bill comes, it's going to say a 22% tip, 25%. It's going to have a thing where because everywhere you go, you have to tip.
Well, listen, and I think there's a variety of structural reasons why inflation. I think
have you seen that?
It's going to be
what?
People that don't do anything that give you that thing, and you have to.
Even when you're serving yourself,
right? And you feel bad.
I don't feel bad.
No.
You just say no?
Yeah. I give myself a tip.
Great.
Well, some guy might spit in my coffee, but
your food
it's okay.
Carefully.
I'm willing to take that chance.
Coffee. It's hot.
It's hot.
Yeah, exactly.
Jason, great to see you.
Thank you.
Thank
you for having me. I appreciate it.
So they won't let anything slow down before November.
Before the election, in my opinion, it's no holds barred. They're using every tool imaginable to keep the economy out of recession and interest rates low. So, thank you.
Thank you.